joining us here at PhillipCapital Market Watch. This is Natalie, REIT and Property Analyst with Phillip Securities Research. Today, I'll be talking about the COVID-19 impact on the Singapore REIT sector. COVID-19 has impacted the subsectors differently. On average, S-REITs suffered a 40% decline in price. The smallest fall of 33% was registered by the healthcare sector, while the greatest decline of 46% was seen in the hospitality sector. The retail, commercial, and industrial REITs declined within the range of 36 to 39%. Recovery is varied as well. The seemingly more resilient healthcare and industrial sectors have recovered roughly 63% of their share price since the fall. The commercial sector has recovered by 43%, retail 26%, with hospitality bringing up the rear with only a 13% recovery in price. The impact on landlords vary by the underlying tenant's reliance on the premise to generate income, and hence the degree of business disruption and the amount of rental assistance rendered, as well as future demands for space, arising from behavioral shifts that have been set in motion, such as familiarization and convenience of e-commerce and the viability of telecommuting. Landlords have some reprieve, given that tenants are locked in by their existing leases. Expansions and new demand are expected to be muted in the short term due to lower business formation and deferment of business expansions. We will likely see more lease renewals along with some right-sizing of space. Negative rental reversions are likely in the near term as landlords trade off rents for occupancy. Extension of lockdowns and restriction on international travel in many countries has resulted in occupancy levels for hotels nosediving to approximately 30%. Alternative sources of income, such as block bookings by the government for isolation purposes, lifted occupancies to the 40 to 80% range. Recovery for the hospitality sector is expected to be slow in 2020 as lingering fear and caution, even after international travel bans are lifted, may keep visitors away. We expect domestic demand to fill occupancies until international travel resumes. The mandated closure of non-essential trade has impacted the retail sector the most. The COVID-19 situation has highlighted the vulnerable positions retail tenants are in due to their thin margins, as well as the market's expectations for landlords to have more skin in the game. During the circuit breaker, approximately 25% of mall tenants were operational. Landlords offered 2 to 3 months' worth of rental rebates to help tenants through this period of non-trading. In the near term, landlords will exercise flexibility in their leasing strategies, which may mean shorter lease terms with higher risk sharing. In other words, lower fixed rent components and higher turnover-based variable rents. We expect a slight increase in vacancy for the commercial sector as tenants rationalize their space requirements. While the successful implementation of telecommuting poses risk to office demand, we may also see companies choosing to adopt lower desk densities and split offices, hence increasing the demand for space. While the industrial sector has a greater exposure to small-medium enterprises, the relatively high percentage of operational tenants, especially in assets where telecommuting is not possible, such as the light industrial and logistic assets, thus give some comfort regarding the degree of business disruptions and the number of tenants that may require rental deferments and/or waivers. The logistics and data center asset classes, which support future trends of e-commerce and cloud storage, will likely see an uptick in demand. That's all for PhillipCapital's Market Watch. Tell us what you think in the comments below. Remember to like and follow us on social media and subscribe to us on YouTube. Thank you for joining us and see you soon.